Welcome everybody. In this video, we are going to discuss about the calculation of the price of zero coupon bonds using Excel. Today, I'll show you a very basic and quick and easy example of bond pricing, specifically the zero coupon bonds. Before beginning the computation, just bring your notebook. I'll mention a brief about the zero coupon bonds and the bond valuation. When I talk about these zero coupon bonds, a zero coupon bond is a bond where the face value is repaid at the time of maturity. Well, this definition assumes a positive time value of money. It doesn't make periodic interest payment, and therefore it doesn't make any kind of coupons, and the name of the bond is called as zero coupon bond. When the bond reaches maturity, the investor receives its par value. The value or the price of any asset is the present value of the future cash flows. So, what we have to do? We have to calculate the price of the bond, and we have to follow the same process that we would to value any kind of financial assets. You have to estimate the expected future cash flows. These are the coupons that the bond will pay. Next, you have to determine the required rate of return. The required rate of return is also called as the discount rate. The discount rate for the bond is the market interest rate called the bond's yield to maturity, or more commonly yield. This is the return one would earn from the bond that are similar in maturity and default risk. So, after getting the information, we have to compute the present value of the future cash flows. So, let us understand the calculation of the zero coupon bonds using this simple example. GEL Production is planning to issue 5-year zero coupon bonds. It has the face value of $1,000 and the discount rate of 8%. The frequency of compounding is twice a year. It is semi-annual in nature. Find out the value of these bonds. To solve this, we need information relating to the face value of the bond, which is written as FV, years to maturity represented as N, coupon rate with a short form of C, interest rate as I, annual coupon as PMT, and frequency of compounding as M. The data is given over here. The first item is the face value of the bond. A bond's face value is the amount that the issuer provides to the bondholder once the maturity is reached. And you have to remember the face value of the bond, or the par value of the bond for most corporate bond is $1,000. The second item is years to maturity. A bond's term to maturity is the period during which its owner will receive interest payments on the investment. When the bond reaches the maturity, the owner is repaid its par or face value. The term to maturity can change if the bond has a put or call option. In this example, the years to maturity is 5. But in this question also, they have mentioned it is semi-annual compounding. We are assuming there is semi-annual compounding. So, for this calculation, the year to maturity will be based on by multiplying the m with n, that is 5 multiplied with the 2, which is 10. So we'll consider 10 years as the number of periods. The next item is coupon rate. A coupon rate is the yield paid by the fixed income security, here the bond. The bond's coupon rate is simply the annual coupon payment paid by the issuer relative to the bond's face or the par value. The coupon rate or the coupon payment is the yield the bond which has paid on its issue date. And here in this example, as I have mentioned, it is a specific type of bond, that is your zero coupon bond. So this bond does not pay any kind of interest during the life of the bond. Therefore, here the coupon rate is mentioned as 0%, and the annual coupon, which is generally calculated by multiplying the face value of the bond with the coupon rate, here it also becomes 0. The next item is discount rate. We know that the present value calculations involve determining the current value or the present value of the future cash flow. The process of calculating the present value is called as discounting, and the interest rate which is used in the discounting process is the helps you in finding out the present value of the future cash flows. So the discount rate is the interest rate used in the discounting process to find out the present value of the future cash flows. Okay, so to find out the value of the bond, we have to find out the present value of the bond using this formula, that is equal to PV bracket rate divided by 2, number of period or NPER multiplied with 2, PMT, and the face value or FV. So let me just enter the values. Equal to, write PV as in capital letter. It returns the present value of the investment, the total amount that a series of future payment is worth now. Then begin the bracket. For you have to enter these values as I have already mentioned: rate, NPER, PMT, and FV. You can omit, type, or write it as 0. So let me start with the rate, which is 8%. But since the compounding is twice a year, we have to divide the interest rate with the frequency of compounding m. So 8% divided by 2, then NPER or the number of period which you already found, that is 10. PMT is 0 because this is a zero coupon bond, and the future value is $1,000. And remember, you have to write the future value of the bond in a as minus $1,000, or else the PV value will come as a minus symbol. So it's better to write the minus value in the face value. Close the bracket and enter. So we found that the present value of this zero coupon bond is $675.56. Remember, since the frequency of compounding was twice a year or semi-annual, that's the reason we have divided the interest rate with 2 and then multiplied the number of period with 2. If it would have been annual, then simply you would use equal to PV, then this directly the rate, NPR, PMT, and FB. Very easy, very simple to do, and that's all for today. Thank you for watching the video and checking my channel. Hopefully you got some value from this video, and if you did get some value, Please like this video and subscribe to the channel. If you have any questions or suggestions, feel free to comment below. Thank you.